Yeah, good evening, ladies and gentlemen. Thanks for joining us today on the second quarter FY24 earnings call of Tracxn Technologies Limited. On behalf of Systematics, I'd like to thank the management of Tracxn for giving us the opportunity to host this earnings call. Today on the call, we have with us Ms. Neha Singh, co-founder, chairperson and managing director, Mr. Abhishek Goyal, co-founder, vice chairman and executive director, and Mr. Prashant Chandra, chief financial officer. I would now like to hand over the call to Neha to give her opening remarks and take us through the PPT, and after that we will open it up for Q&A. Please use the raise hand option to ask the question, or you can also submit your questions in the Q&A box at the bottom of your screen. Thanks, and with that, over to you, Neha.
Thanks a lot, Siddharth. Welcome everyone. Thanks so much for joining us today for our earnings call for the second quarter of the financial year FY24. We are very excited to present our results for this quarter. In terms of the format, we would like to run through a short presentation and share some key highlights for this period. I will also give some commentary along, which will be helpful for the overall understanding. And then we'll follow it up with a Q&A session. Request you to go through the standard disclaimers for this presentation. A quick recap on our business. Tracxn is a data and software platform for the private markets globally. If you look at the public markets, it has created multiple large companies, many of which are highly cash-rich and profitable companies. As private markets are becoming large and important, it will also create platforms like these. And we are building a global platform in this space. Our customers include venture capital funds, private equity funds, investment banks, as well as M&A innovation teams of large Fortune 500 corporations. Also, it's a global platform, so nearly 66% of our revenue is international, and we have customers in over 50 countries. I would like to begin by summarizing the financial performance of Q2 FY24. To set the context, we have one business, one legal entity, so you will not see terms like standalone or consolidated. All the numbers that I'll talk about is for the business overall. Revenue from operations for Q2 FY24 was 21.5 crores, which is an annualized run rate of 86 crores. This is a 12.5% year-on-year increase. Total income was 22.5 crores, which is an annualized run rate of nearly 90 crores. Coming to profitability, EBITDA for the quarter was positive 2 crore. Also to add, this EBITDA includes all the non-cash expenses also, like ESOP charge. PAT for the same period was 2.2 crores. Moving on, EBITDA margin was 9.5 crores and PAT margin was 10.1 crores. I will quickly summarize the YTD numbers as well, or the financials for the first half of the current financial year. Revenue from operations was 41.3 crores, which is a 10% year-on-year increase. Total income was 43.2 crores, which is a 10% year-on-year increase. In terms of profitability, EBITDA was 2.1 crores for the first 6 months and PAT was 2.9 crores. In terms of the margin, EBITDA margin was 5%, PAT margin was 6.9%. The business continued to generate positive free cash flow. The free cash flow for the first half of the financial year 24 was 0.6 crores. Cash and cash equivalents stood at nearly 63.1 crores, which is an increase of 20% on a year-on-year basis, or an increase of 10.7 crores in absolute terms on a year-on-year. In the subsequent slides, I will be covering each of the metrics we talked about in the summary in more detail, starting with revenue. Revenue from operations is essentially the revenue from platform subscriptions. 100% of this revenue is subscription-based. There is no services or one-time implementation component. So this is a fairly high-quality revenue. Also, please note that this is accrued revenue. So though we do prepaid billing and collections like most other financial data platforms you may have seen, we only recognize revenue for the time duration falling within the reporting period for which the service was made available. As discussed earlier, revenue from operations for Q2 FY24 was 21.5 crores. Revenue growth has started seeing acceleration after the declining growth of the last 3 quarters. Revenue from operations grew at 12.5% on a year-on-year basis, up from 8% year-on-year growth that we had seen last quarter. Total income also saw similar acceleration in growth rate. Total income for the quarter was 22.5 crores, which is an annualized run rate of nearly 90 crores. This grew at 12% on a year-on-year basis, up from 9% year-on-year growth that we had seen in the last quarter. We have also added historical data for the last 3 financial years for reference here. Moving to EBITDA. EBITDA for Q2 FY24 was 2 crore. Please note that this includes all the non-cash expense, also primarily ESOP expense. If we exclude these non-cash expense, the adjusted EBITDA will be 3.1 crores. Quarterly EBITDA margin was 9.5%, which is an expansion of 4.8% on a year-on-year basis. Also, please note, this is the highest quarterly EBITDA and EBITDA margin that we have seen over the years. On similar lines, PAT for Q2 FY24 was 2.2 crores and a PAT margin of 10.1%. If you exclude the non-cash expense like the ESOP expense and the tax set-off with deferred tax asset, the adjusted PAT for the quarter was 4 crores. Similar to EBITDA, the PAT for the last quarter was also the highest quarterly PAT and PAT margin that we have seen. Just a point to note here, in the PAT calculation, you will see also a tax component, which is the tax amount set off with deferred tax asset. So this is a non-cash expense, as we don't have to pay taxes as we have accumulated losses. But this non-cash expense is included in the PAT calculation from this year onwards. Moving on, one of the other matrices that we track closely for the business is what part of the incremental revenue is going into bottom line. We saw this metric increase this quarter with the revenue growth accelerating and the expense stabilizing. In the previous year, it has been much higher. So in FY21 and FY22, it was close to 80%. Last financial year, which is FY23, we had seen when we had increased the average team size by 23%, this metric had reduced to 31%. Last time there were some questions around when do we expect this number and what do we expect this number to be going forward. We had mentioned that we expected to come back to over 50% over the next couple of quarters. So the good news is that it has come back to this mark this quarter itself. So in Q2 FY24, the percentage of incremental revenue going into bottom line was 48%. So this is a very healthy improvement over 31% that we had seen last financial year and from negligible that we had seen previous quarter. Coming to the expenses, the total expense for Q2 FY24 was 19.5 crore. This is 7% increase over the same quarter previous year. If you see, this expense growth rate is lower than the CAGR seen across last 2 years, which is what we had also indicated in the last quarter. On the right hand side of this slide, we have also given the breakup of this cost across the key components. The key components are the same as what you had seen previously. Just to summarize, first, bulk of our expense is team cost. So in Q2 FY24, this was 88% of the total expense, which has been in the same range across the last 2 financial years as well. In FY22 and 23, this was 89% and 88% respectively of the total expense. Also note, all our team is in-house, so there is no outsourced or contract workforce. The second largest item is cloud hosting cost, which accounted for 3.3% of the total expense, as we do a lot of data processing and analysis. This is followed by the rental expense. The other interesting aspect is that we do not have a large paid marketing expense line item. because we do not have a large paid marketing spend, neither digital marketing nor offline based, typically required for customer acquisition. The reason for this is that because we are a data company, we produce a lot of content and hence are able to use a lot of this to get organic traffic. So we are able to acquire leads fairly efficiently, which is also reflected in our expense breakup. Moving on to doing a deep dive on the expense growth rates. If you see the year-on-year expense increase over the last 2 financial years, it had increased from 7% in FY22 to 16% in FY23, right, which was the last financial year. This was primarily on account of headcount increase. We had indicated across the last 2 quarters that this should get eased. So in Q1 of the current financial year, it had come down to 9%. And now in Q2 of FY24, this has come down further to the FY22 level of 7% year-on-year increase. This again is very much in line with what we had indicated earlier. In this slide, we have also given the details of the main drivers for that. So employee cost, which we had mentioned earlier, contributes to nearly 90% of the overall expense. We have given the average headcount across the last year and the last 5 quarters. So if you see, the average headcount had increased from 684 in FY22 to touching a peak of around 900 in the last quarter of FY23. This increase in headcount was due to various growth initiatives undertaken last year. In Q2, it has come back to 783. This headcount got optimized primarily due to various automation and efficiency initiatives that we have done. Moving on to the revenue side, I wanted to talk a little bit on the market. So if you see, the private markets have been very muted, across the last 9 months of this year. And I'm sure you would have read a lot of commentary about this in press as well. But just to put into perspective about the deal activity among the private market investors. So if you see the global tech funding, it is at a near 6-year low. Funding globally in the first 9 months of the calendar year 2023 was down nearly 50% if you compare to the first 9 months of the previous year. Similar was the trend in India, where it was down 72% in the first 9 months of the current calendar year 2023 over the same period previous year. This was more stark in the later stages. One proxy for the late stage activity is the number of new unicorn startups that got created, or the new private companies that got valued at over $1 billion. Current run rate of new unicorns that got created globally, which is a proxy of the investment activity in the later stage, was lowest that we had seen in the last 7 years. India obviously saw only 1 new company got added to the unicorn list in the first half of 2023, coming down from a peak of about 44 that we had seen just 2 years back in 2021. Also, if you look at the M&A activity, it has been fairly muted. If you look at the M&A deal volume in the 9 months of 2023, it was the lowest that we had seen in the last decade. Even if you look at the IB fee, the investment banking M&A advisory fee, that is, it is one of the lowest that it has been in the last 10 years. On the question of when it is expected to improve and bounce back, so last time we had mentioned that typically we have seen a lag of about 2 to 3 quarters between public tech and private tech. And with the public markets having recovered this year, it is likely to see some recovery in the private tech also. We are already seeing this recovery in the private market happen. So if you look at the monthly trend in the private markets, right, you can actually see early signs of that the recovery has started happening. So if you see the year-on-year growth rates, the declining trend, which was happening for the last few quarters, has started to reverse. So this is the same trend that you see in the global funding stat as well as in India. This is also something that we are also seeing anecdotally around, which is that the deal activity seems to have picked up. So on the whole, the good news is that it looks like the private market deal activity seems to be bouncing back. Coming to some of the matrices of the business that we are seeing. So we are continuing to see green shoots. Last quarter, for instance, we had mentioned that if you look at the deferred revenue, we had started to see the downward trend reverse and slight acceleration in the first quarter of the current financial year, which is FY24. The good news is that this upward trend continues, and we saw further acceleration in our deferred revenue last quarter. So the deferred revenue for Q2 FY24, if you adjust it for the change in billing methodology, which I'll cover in the subsequent slide, it grew to 31.3 crores, which is a 26% year-on-year increase, right? Which is a further acceleration from the growth that we had seen in Q1. I would also like to share a note on the slight change in billing methodology that we have done in Q2 FY24. This might have some impact on some of the matrices over the next couple of quarters, after which it should stabilize. In the new methodology, only for one subset of accounts, currently all newly onboarded accounts, we raise invoice after the cash collection, instead of the typical way of raising invoice and then doing cash collection. This is to reduce possibility of bad debts and consequent tax expense, especially for export invoices. Please note that this was not a large number, but we have done it more for prudence purposes. We have also given the numbers in the slide. And this was done from mid of Q2 FY24. Hence, a portion of the billing for Q2 for new accounts has shifted to the next quarter. This does not have any impact on revenue. However, there's a one-time impact on contract price and deferred revenue. In terms of some of the other matrices, platform engagement metrics continue to look very healthy and increase. If you look at the platform usage, which here is in terms of the number of exports and my data queries that customers have sent, it has nearly doubled across the last 2 years. Engagement has increased both at an overall level as well as a per user level. So this is a very healthy trend that we see. Apart from these, we at our end have also been investing heavily across various growth initiatives. So these spans across the go-to-market funnel of marketing, sales, and account expansion. We believe as the markets open up, we should see more acceleration in the new customer acquisition as well as customer expansion. I would also like to take a couple of minutes to recap on some of the growth initiatives we are aggressively working on, and we are very excited to present the results from what we are seeing from those. One of the very interesting growth initiatives that we have talked about previously is scaling our organic traffic. So because we are a data company, we are able to use a lot of data that we own to launch a large set of public pages, which generate a lot of customer traffic. For instance, if someone is searching for fintech companies in Sweden or SaaS startups in California, they come across our pages and we are able to generate leads through that. So if you look at the organic search traffic that we got across all our pages, this was 8.7 million in the first half of FY24. So 3 things regarding that. One is that this is a very large traffic funnel that we've been able to build. Second, it has grown rapidly, as you can see, across the last few quarters. For instance, it has grown nearly 8 times in just the last 3 years. Thirdly, we continue to work aggressively on this and we expect it to increase even further. Another interesting growth initiative is press mentions. As we have mentioned previously, whenever media talks about data on private markets or startups or emerging technology sectors, we want them to quote data from Tracxn. Our recent initiatives like launching reports with media, data contributions, regular column in some newspapers, etc., have resulted in multifold increase in press mentions that we have received across various respected media outlets. Advantages of press mention is that a lot of people discover our data for the first time through media, and then they come to our website and generate a very high intent lead. Also, we believe this goes a long way in building a brand as a data company, and hence also helps in our sales conversion and hence the revenue growth. Another interesting growth initiative that we had mentioned previously on the data side is that we are expanding coverage in financials and cap table data sets on private companies on the platform. For context, today we cover financials across over 15 countries, cap tables across over 10 countries. These data sets are particularly in demand by certain customer segments like private equity and investment banks, among other segments. For illustration, an investor wants to scan an upcoming space like a single specialty hospital chain or a D2C internet first brand in a particular country. Then in addition to the list of interesting companies and market landscape, they would also like to find out companies beyond a particular revenue threshold. Since we now generate sufficient cash, we have invested in increasing the throughput of these data production engines. And we believe that this will help us accelerate the revenue growth in future, particularly in customer segments of private equity and investment banking. Another set of initiatives which are underway is for improving paid customer engagement as well as account expansion to enhance essentially growth of revenue from existing customers. A separate team has been set up to increase the penetration of paid licensing within existing accounts, thereby moving from more reactive upgrades to doing more proactive upgrades. We have also set up a separate team within customer success for various engagement initiatives aimed at increasing user level as well as account level engagement through a variety of initiatives. To give an example, like better platform education or periodic touch points or hero features or personalization and many more. Moving on to some of the other financial metrics. The company generated positive free cash flow of 0.6 crores in the first half of FY24. If you see, this is a decrease over the first half of FY23 last year. The only reason is basically there was a slight delay in realization of some of the payments which actually came post the quarter end, and pending tax refunds which we expect to be realized over the next 2 to 3 quarters. So we expect this number should come back to a much higher number next quarter. Cash and cash equivalents stood at 63.1 crore, which is an increase of 10.7 crore on a year-on-year basis, or a 20% increase on a year-on-year basis. So interestingly, despite these investments in various growth initiatives, the company continued to generate positive free cash flow and also increased cash and cash equivalents both on a year-on-year basis as well as on a sequential Q-on-Q basis. In the subsequent slides, we have covered some other KPIs for the business. On the first slide, we covered number of customer accounts and number of user accounts. So we closed September 23 at 1258 accounts and 3,420 users, which are 9% and 2% growth on a year-on-year basis, respectively. Please note, in terms of number of users, we had done some slight tightening in terms of the number of non-paying users within paid accounts, which had reduced the number of users, but does not have any impact on the revenue. In fact, we hope to have more expansion through this as some of the accounts would buy more licenses due to this. In terms of some of the other KPIs, contract price or invoicing amount for Q2 FY24 was 21.7 crores, adjusting for the billing methodology change, which was discussed earlier. This is a 22% increase over Q2 of last financial year. The last graph talks about the entities profile, which is a proxy to the amount of data added onto the platform. So today we track more than 2.4 million profiles, including private market companies, funds, etc. globally. In terms of some of the other interesting characteristics of the business, 66% of the revenue for Q2 FY24 was from outside India. This has been almost in the same range, about close to 70% across the last 3 financial years as well. These customers span over 50 countries. The top 5 countries within this show a similar pattern to where you have large corporates as well as private market investors. So the top 5 countries for us by the number of customer accounts are India, US, Singapore, Germany, and UK. Additionally, we also serve a rich and diverse customer base across the investment industry, including venture capital funds, private equity funds, investment banks, as well as corporates across their M&A team, innovation teams, etc., and others, including government agencies, universities. Right? So this gives us a very large addressable market to tap into. So with this covers most of the key updates from the recent period. In the subsequent slides, we cover the business overview. I will skip going over these slides, but please feel free to check it out offline. Subsequently, we also have some slides in the detailed financial statements, which people can go through in detail. Thanks, that's all the key items that I wanted to share. Passing it back to Siddharth for any Q&A that the group might have.
Yeah, right. So, thank you, Neha. And now we'll start the Q&A session. Participants can raise their hands or write down their question in the Q&A box at the bottom of your screen. Once we call out your name, you can unmute yourself and ask your question. So we'll just hold on a minute. Okay, so we have the first question from Harsh. Harsh K, would you like to unmute yourself and ask your question?
Yeah, hi. Hope I'm audible. Just a couple of questions. First of all, thanks Neha, thanks Abhishek. Good set of numbers. Just a couple of questions on the cost side. So you guys were talking about the employee optimization. So could you just elaborate a bit more on that? Are we done with the optimization phase? How should we see the headcount number going forward? That's the first thing. Secondly, we are still seeing on a quarter-on-quarter basis some consolidation in the number of users. Now, this is despite some revival in the PE funding that you called out, Neha. So how do you see this number going forward, and how do we triangulate that with the growth that we saw in this quarter?
Got it. Thanks, Harsh. So I'll just take the first question, which is basically on the cost optimization. We talked about the headcount getting optimized, and how do we firstly, what is the reason for that? So one of the key reasons was basically there is a lot of sort of automation and automation initiatives which keep happening. So that's why one part of the team, like the data operations team, which is there, so that keeps getting optimized. So for instance, if you build launch financials in about 20 countries, cap tables in so many countries. There's this, once you build models, then, over time it gets optimized. So the number of people that we require per module, that decreases, right? So that was one of the reasons that you had seen in terms of the headcount increase. On this point, I'll just note that, if you look at the headcount might have decreased a little bit, like if you compare Q2 of the current financial year to Q2 of last financial year, the headcount actually decreased marginally by 4%, but the cost had actually, increased or like remained flat or slightly increased. One of the reasons is that obviously we are not the cost optimization is not the reason for the headcount, sort of optimization. I think this is a natural, automation initiatives which keep happening through the org. Right? So that's one on the reason for why, the optimization happened. Coming to the second part, which is how we expect it to going forward. So, my sense is that most likely the employee count should sort of stabilize at around, between 750 to 800, across the next probably few months. That's why we're also sort of indicated with the cost increase you can sort of expect, should be like less than 10% for the overall expense that you can expect, right? So hope that answers the question on the first part, which is, the optimization part.
Yeah, it does. Thank you.
Okay. Now coming to the second part, which is the number of users. So that's an interesting question. So if you look at the number of accounts, that has increased by about 22 on a sequential Q&Q basis, but the number of users have actually, sort of decreased. So on the user base, there is also, optimization that we had done. So the number of users that that is there here is basically the number of activated users that are there for all the paid accounts on the platform, right? What typically happens is that, people like customers sign up for some number of license seats, and then we give them a few other additional seats so that in the next upgrade cycle, we are also able to upgrade some of them. So the number that you see is the number of users. So we've also done some tightening in terms of the additional users that we've given to some of the accounts. That's one of the reasons why you can see the user count getting optimized. But you can also see another number, which is, the average realized pricing per account as well as per user. So if you look at this quarter, both the realized pricing on per account, that has increased. So that increased from 6.7 last financial year to 6.9 in the last quarter. And the realized pricing for the users have also increased marginally from 2.4 last financial year to 2.5 lakhs per user per year. Right. So there is also, that is also getting optimized. Like, we're able to also increase a little bit on that front. Right. So I think that is, so I think the net is basically, including both of these aspects. Right. Hopefully that answers the question on the user growth.
Got it. Thanks a lot.
Thanks, Harsh.
Yeah, thank you, Harsh. Well, we have a question on the chat window from Ajit Kumar. Hi, Neha. Other than core revenue, do you see any other opportunity of data monetization? From Ajit Kumar.
See, so just to take that question, Ajit, I think in terms of the revenue ones that we have, so one way to think about it is by customer segment. The other way to think about it is by geography. In the customer segment, if you see, nearly half of our revenue is from private market investors, which includes your venture capital funds, private equity funds, etc. The other half, interestingly, like corporates, is actually equally large for us, right? Wherein we continue to see expansion in different use cases. So we started with the M&A as a use case, innovation teams as the other use case. We are also seeing a lot of uptake in the sales team within that, right? If someone wants very targeted sort of information on customers that they can go behind, so we have sort of very classified data, in that sense. So that's another segment that we are seeing growth. We are also seeing growth in corporates across all the sizes, small as well as large, within this use case, right? So I would say, in terms of the customer segment also, there are few customer segments that we are seeing sort of more growth in, right? So that is one idea. And the other is, of course, we continue to sort of, increase in terms of some of the geographies wherein we already have sort of, a good referenceable customer base in, right? So for instance, India and America sort of grew, both in terms of the percentage within this quarter, right? So hopefully that answers the question on the revenue opportunity in the other segments that we are seeing.
Yeah, fine. Thank you, Neha. So we have Urvi Shah's hand raised. Urvi, you could unmute yourself and ask your question, please.
Yeah, so thanks a lot for giving me opportunity. Actually, I'm speaking on behalf of my wife, who is the investor. So first of all, congratulations on setting up a decent number. Okay. One question, is that, it's been barely 1 year, that we've been listed. Probably it's just 1 year that we finished listing. Unfortunately, it was a totally OFS, if I'm not mistaken. All right. So I still see, promoters, reducing the stake. Now we have total confidence of, in the company as also in the management, and hence we are still in with the company. But, if you see, the promoters continuously, reducing the decreasing the stake, it really doesn't give us the confidence to, going further. I mean, if you can just clarify, because it's barely 1 year that can be listed, it was a totally OFS. So, I hope if you can clarify, please.
Yeah. Go ahead.
Thank you so much.
So I'll just address to that. So we actually, so the IPO was an OFS, which was sort of a requirement in terms of liquidity that you need to have. But actually, I don't know, there's this thing, the promoters have actually not been selling at all after the IPO. They've not even sold. In fact, on the other side, the promoter group has been buying shares, after the contra trade obviously sort of ended, and when you could do that. So it has, I think the promoter group has been buying more. And maybe Abhishek, if you want to add.
Yeah, I wanted to reassure that first 6 months there was a lock-in, so we couldn't trade after the IPO. After which every quarter there has been some buying from the promoter group. And you can see it on NSE's website, they are all visible there. And once you buy for 6 months, we can't do a contra trade. So every quarter we try to see that we buy some stock so that there is a confidence that we are not going to sell for next 2 quarters, next 6, 9, like at least 180 days.
Oh, okay. So I don't know why the BSE website of CNN, it shows a reduction in the. Is it because of ESOPs or any other dilution?
Yes, it might be because of ESOP.
Correct. Yes.
Prashant, maybe if you have it handy, you can show the NSE's website that where we have been.
So basically there is a marginal, very slight reduction. So as of 30th of June, it was 35.56, the promoter and promoter group holding. And as of 30th September, it is 35.22. So the marginal reduction that you see is on account of the ESOPs being issued pursuant to the employees exercising the stock options.
Oh, okay. Clear. Apologies.
We have been buying. Don't worry. You'll see us only buying.
Thanks a lot for your clarification, and wish you all the best in all the future endeavors. Really appreciate your response.
Thanks a lot.
Yeah, thank you for the confidence, Abhishek and Neha. And we have a question. Yeah, sorry. Yeah. So we have one question in the chat window. Within headcount reduction, can you let us know in which teams the reduction has happened?
Yeah, I'll just take that. So if you see there are, there are 4 teams which are essentially, which we sort of give the split across. So if I were to just summarize the team of about, 750, the way it splits across the 4 teams is about 90 member, in tech and product, about 370 members today in data and analyst operations, about 220 members in sales and marketing and customer success, and about 60 people in business support, right? So these are the 4 groups that we have been sort of giving out, how the headcount sort of splits across. If you look at the headcount reduction which has happened, it has primarily happened in the data operations layer. As I was saying that a lot of the modules keep getting optimized. So as you sort of, launch new modules, you do that. Once it gets live, there's also a lot of operational efficiency that is there across all the modules. So the number of people that you require to keep running on an ongoing basis across all these modules, right? Whether it is, to give you examples, whether it's financials in a particular country like Germany or a UK or India or Singapore, or it's cap tables, or it is global funding transactions someone is covering, or the team which is covering global M&A, etc. Right. So what we have seen over time is that the number of people required in across all these, there's a lot of operational efficiency which also kicks in, and the number of people reduces. Right. So that is the same team that had got optimized. So hopefully that answers the question.
Yeah. Thank you, Neha. So participants, if you have any questions, you can kindly raise your hands and ask a question. And in the meantime, my colleague Samir has a question, so I just hand over the screen to Samir.
Yeah, hi Neha. Can you elaborate a little bit about the new billing system that we did this for the quarter?
Right. Yeah, so I'll probably give a brief and then I'll pass it on to Prashant, to add on this. So essentially, what happens is that, to give you an example, if there is if there's an export invoice which is there, which eventually got written off. There is a tax liability which happens on that, for instance, GST with interest happens. So what we have done is essentially instead of raising the invoice earlier, we wait for the cash collections to happen and then raise the invoice. What this helps us do is reduce the component of for instance, the bad debt that is there, as well as the tax incident which the company has to bear. The overall expense was not a lot, like we had given in the slide. For instance, the last financial year, on a revenue from operations of about 78 crores, the total write-off was only about 74 lakhs. It was a small component, less than 1%, but still for prudence purposes, we have adopted this. Okay? And I'll also, pass it to Prashant to probably add over here.
Yeah, sure. So, Samir, like we have mentioned, so earlier we would raise an invoice, which is like book the sales and then subsequently over the due course collect the payment. But in for the select accounts, like the newly onboarded accounts, we are now actually waiting for the payments to happen before we are actually booking the sales. So in a way, it is also helping us to reduce the bad debts, as well as and I also mentioned the export invoices, especially because the moment the export invoice turns into a bad debt, that is that you don't realize payment, the criteria under the GST laws for export fails. And since our business falls into the export of services, which is zero rated supply, so then immediately GST becomes applicable on it and with interest. Right? So to reduce those instances, we are now insisting first to receive the payment before we sort of book the invoice and record the sales. Is that clear, Samir?
Yeah, absolutely. And then upon account tightening that we are doing, is it a continued process? Maybe we'll do it in the subsequent quarter as well.
Yeah, so I think we had done, I think bulk of it is done. We continue to do a little bit. So you can probably see the realized pricing per user, maybe increase marginally over the next, couple of quarters. But that's about it. I guess, we'll be, bulk of it is done, and then we'll continue to do a little bit in the coming quarters.
Sure. Thank you. Anyone has a question, please raise your hand.
Any answer?
Rahul has raised them.
Yeah, I think Urvi has a question. Urvi, you have a repeat question?
Yeah, thanks for giving the opportunity once again. So the same question would be like, okay, we saw a reduction in the headcount, right? So will this, give us some reduction in savings going ahead? And will there be a further ESOP expenses, in the coming days?
Right. Yeah. So just to add to that, the primary motive for headcount decrease was not so much a cost optimization, but it was more of an output of the headcount reduction which has happened. Mainly the reason was that the automation initiatives, and the efficiency initiatives that keeps kicking in. In terms of the cost impact of this, I guess bulk of it, that is why if you look at last financial year, the total expense had increased at about 16% on a year-on-year basis. That has come down to 7%, this quarter, which was in line of what we had seen in FY22, or if you look at a more longer historical period, right? So this has come down to, the longer sort of the growth rate that we had seen in terms of the expense, right? So I guess bulk of it is done. On the second part, which is on the ESOP expense. So the ESOP expense, the way to think about it is that, we do not have sort of, we don't give bonuses. So a part of the component of your salary of employees is basically based on ESOP. And as we had mentioned that, you can expect the ESOP expense to be in the same range, about, 6 to 8% of the total employee benefit expense, right? And, it continues to remain in the same range.
I mean, how far are we expecting this? I mean, going ahead, I mean, the next year or 1 year, 2 years?
So I think most of it is done, and we expect that the headcount should stabilize between, around 750 to 800, between that range.
No, I'm talking about the ESOPs basically.
So the ESOP will be part of an ongoing basis. Just the way to think about ESOP is that it is a part of your salary. So we don't have, for instance, bonuses. A part of your salary is actually paid to employees as ESOP expense based on when the appraisal happens or when the joinings happen. Right? So this is a part of an ongoing expense that you will continue to see in the employee expense, and this is the same pool that we had sort of created. So there's no additional pool that has been created.
Clear. The last question, any dividend distribution policy has the company thought of?
Right. So yes, we like we do generate cash, and if you look at it, the cash and cash equivalents have been increasing. So I guess over time we will probably do one of these three things, right? Either do dividend or buyback or do some part of inorganic expansion over time. Right now we don't have a timeline in mind of either a dividend or a buyback or doing this. And maybe we'll take a call, in the next couple of quarters on these things, and we'll sort of communicate accordingly.
Yeah, and just one thing what I heard, that is the company applying for any inorganic opportunity?
Right. So right now there's no immediate inorganic expansion that we have sort of that is there. We will probably have, we'll probably do, if you look at most financial data companies, inorganic is part of your growth strategy. We do not have any immediate plans of doing that. So maybe in the, maybe a year later or so, we might think about that.
Clear. Absolutely clear. Thanks a lot once again for clearing all the queries. Really appreciate it.
Thank you so much.
Yeah, thank you, Urvi. I'd seen hand raised of Rahul Jain, but now it's missing. So we'll move on to Amit Chandra and then we'll take Harsh K. So Amit Chandra, would you like to unmute yourself and ask your question?
Am I audible?
Loud and clear.
Yes.
Yeah, hi Neha and hi Abhishek, and thanks for the opportunity. So we have seen some recovery in the growth rates and also in terms of the incremental EBITDA contribution and the margins. But I would like to understand how do you see the business momentum shaping up? So we had a fairly flattish kind of an quarterly run rate over the last 4 quarters. But are you seeing on ground pickup, because most of the investments are mostly behind in terms of sales and marketing, in terms of whatever investment that you have done. So when we can expect this growth, YOY growth rate to reach at least what we were doing say a year back, and in terms of your sales engine, how confident are you that the current sales engine is able will be able to generate that kind of growth?
Thanks a lot, Amit. So I'll just take that. So in terms of the momentum, we are actually seeing the momentum sort of pick up. Like if you look at, all the business metrics, the deferred revenue has started picking up. For the last 2 quarters, the revenue growth rate has started accelerating from this quarter, right? So that we started, sort of picking up. I think 2 reasons for that. One is, if you look at the market, which had been, very low. If you look at it, the numbers have been one of the lowest that you had seen in the last decade, both on the funding side, on the M&A side, etc. Right? So that was there in the market. So that activity is picking up. Like if you look at the market stats, there seems to be recovery in the private markets, which is starting to happen. So so one aspect about this is the market, wherein more deal activity has started to happen. The other is also the GTM initiatives that we have done. Right. So for instance, our traffic, which is increased, like doubled, more than doubled in the last just 1.5 years. And all the other GTM initiatives that we are doing. So we are also getting good, sort of results from there, through which, one is we are able to generate a lot more leads. That means a lot more demos for the sales team. We had also expanded the sales team earlier. And the third thing is that we're also working right now on a lot of on the expansion initiatives. So you will also see sort of, growth in that. Right. So there is also the second part, which is the GTM initiatives that we are working, which are also seeing results. So in terms of the momentum, we definitely see overall the momentum, seems to be picking up. in terms of the revenue growth, and we hope that that should continue. And hopefully in a couple of quarters, it should go back to the level that we had seen if you look at the last 3-year CAGR types. Right? So hopefully that answers the question on the first part, which is on the momentum. On the second part, which is on the sales engine. Right now I think our sales engine is in a fairly good shape in terms of both the coverage that it has, in terms of both the depth that we've been able to build. What we are also doing is building sort of sub teams. So, for instance, there are few segments wherein we are seeing a lot more growth. So we are also carving out the sales team specifically for that. To give you examples, like sales and marketing was one segment which was seeing growth for us. So we have actually set up, a separate team to just focus on sales and marketing leads, because we are getting a lot of those. University is another account which is, not just a revenue, but also a big marketing channel for us. So we set up a separate team for that. Right. So in the sales team also, we are continuing to sort of do a lot of those things, carve out sort of separate teams wherein we are getting either a lot of inbounds or we see scope for improving the penetration much more. So in terms of the headcount, most likely it should remain, but there are a lot of initiatives which we continue to sort of do within that.
Okay.
So
And
yeah.
Thanks for that. And also in terms of the organic growth that has been increasing on the platform. So is there any specific trend or any specific geography which you are targeting, apart from obviously, like US is there, which is the largest market, and apart in terms of geography mix, if you can say where the organic traffic is coming in, and also in terms of the closure to demo ratio, how that has been, and also in terms of what has been the mix of the generation in terms of lead versus inbound and outbound.
Got it. Yeah. So let me take that. So the first is basically on the organic traffic and where we are seeing. So the driver for the organic traffic is basically the content that is there on the platform. And if you see the content on the platform, it is the natural distribution of where you have a lot of private market companies, sort of investable private market companies. So US being the largest, followed by and EMEA and APAC. Right, so this is the natural distribution. So that is why the public pages, which is also there, is or the data that we also use for organic traffic is basically global, right? And that is why the in terms of the traffic that we are seeing, so it is fairly, I would say, across the countries that we are seeing sort of growth in traffic that is there, right? So that's on the first part on the organic traffic, which is sort of a natural distribution of where the data is, which is sort of global. Now it's coming to the second question, which is your demo to closure ratio. So that has remained in the same range. In fact, for a much longer period, for the last 2 to 3 years, it has broadly remained the same range of between 15 to 20%. What we try to do is basically, all the new incoming team as well, how quickly they are able to reach to this sort of an average demo closure to demo ratio. We don't expect that to change much. What we are doing a lot of is also increasing the top of the funnel, which is the number of demos that that the team is basically taking, or we are able to generate, or the marketing team is able to generate. So that we are also focusing a lot on. The conversion, we expect that to be range bound. And coming to the third one, which is the mix of
So inbound and outbound.
So it also happens to be the same, which is bulk of it is inbound. More than bulk of it is inbound, and a part of it is also outbound. But bulk of the closures that we see is in terms of inbound. Like people have already seen the content, or people have already seen it somewhere. Then it's easier for us to sort of close and do it in a sort of limited sales cycle time.
Okay. And if you can provide, so the average headcount has been coming down, but in terms of the headcount, I know there is a higher mix of people who are maintaining the data. But in terms of the sales team, how the sales headcount has moved, Okay. And if you can provide some numbers around how many salespeople are there and how many are front end and how many are like maintenance sales.
Right. Yeah. So if you look at, so in terms of the sales headcount, so the sales headcount after the ramp up that we had done of about, from a smaller team to about 220 members, not the sales, but the entire GTM team, which includes your sales, marketing, customer success. So that has been around in the same range of about 220, right, for the last 2 quarters. Within that, the sales team, which would be around about 140 people, which includes people which are closing as well as other support team, which is doing sales enablement, which is doing sort of SDR, which is your lead qualification, etc. So it includes all of them, right? So the closing team would be smaller than this. Right? So that is on the sales sort of team.
Okay, and now like one last question from my side. So on the pricing for the product. So when we have taken a price hike and when we are planning to take a price hike. So and what are the factors that we consider while taking a price hike?
Right. So in terms of the price, if you look at it, currently our pricing currently is about $600 per month per user, which is the minimum single user pricing that we start with. 2 years back, this pricing was $500 per user per month. Sorry. Right. So there was a 20% price increase that we had done about 2 years back. The way to think about pricing is that it does not get reflected across all the customer segment, the customer base on day one. We typically implement the new pricing for the newly onboarded customers, and for the existing customers, we actually do it as the renewals happen. And all of them may not renew on the first renewal. So we give people time, within the next 2 to 3 years, most of the customers will come to the new pricing, right? So that is the way that the pricing is there. And the other thing that we have also been working towards, so it's not just the pricing increase, but how do we increase the realized pricing per account, right? So a lot of initiatives that we have done is, for instance, increasing the number of licenses that a account ends up buying. To give you an example, on an average, typically accounts buy 3 users, from us, and but the team sizes are fairly large. So typically, a lot of accounts prefer to start small and grow over time. So a lot of work is also being done on how do we sort of grow within the account. So it is not just the pricing increase that we see grow, that can be the lever for increased realized pricing, but also these initiatives, for instance, if you are able to add more licenses, have more users within each account, which will also increase the realized pricing per account. Right? So if you look at this quarter, for instance, the realized pricing per account as well as the realized pricing per user has increased marginally, right? Because of a lot of these initiatives that we have done.
Okay. And now, are you seeing any kind of price negotiation at the time of renewals? Because if anyone is increasing the user per account, okay, then are they asking for a price discount for that?
Right. Yeah. So interestingly, for this segment, we don't see a lot of price negotiation happen, especially in the private market investor side. There's not much of price negotiation happens. Maybe on some smaller corporates, we might see some of them, but actually there is fair amount of stability which exists within this customer segment. So there's not a lot of price negotiation which happens. And also on our side, our pricing has been fairly standard. So if you see, pricing we actually displayed on the website, there's not much differential pricing that we do for users, right? So I think people are also fine with the fact that, it's a standard pricing. So we don't see a lot of price negotiation happens. And there's a very standard pricing that we also give out, on the website, which talks about that if you buy so many users, the incremental users will be slightly cheaper. And that is what the teams also follow, right? So, and that customers are fine with. So we don't see, them negotiating a lot. As long as, it's standard for everyone, I think people are fine with. And we don't see a lot of negotiation in this segment, especially.
Okay. Okay, Neha, thank you and all the best for the coming quarters.
Thanks a lot.
Yeah, thank you very much. So next question is from Ayush Vimal. Ayush, would you like to unmute yourself and ask your question?
Sure. Hi, Neha. Thanks for giving me the opportunity. Neha, I just had one question. Over the last 1 year, I've been hearing of another competitor, who's been very aggressive in the market. Do you see that, do you see the competitive intensity in the sector increasing because of that, entrant? And if so, how do you see, the pricing, in the immediate term? Are you facing pricing pressures from some of your clients, who are taking simultaneous demo with both competitors?
Thanks a lot, Ayush. So just to answer that, we haven't seen much increase in competitive intensity, across the last, 1 to 2 years. It has been the same sort of players globally. As it's a vertical industry, there are only about 5 or 6 players which exist globally that, that we run into. But that's about it. And there's also differentiation which exists. In terms of players, there are a lot of these point solutions which sort of exist, right? Which are giving you one particular data point. But typically we have not seen a lot of competition from them in our sales team, or we don't hear a lot of their names from our sales team because there's only one part of the data that they offer. However, if you look at the typical workflow of our users, which is an investor or an M&A professional, there are a lot of things that they need to do, right? From deal sourcing to deal diligence to so not just financials, but they would actually look at the sector. They would want to look at global comms. They would want to look at transactions. They would want to look at the funds portfolio which they are meeting. So this is like your platform that you spend a lot of the time on, right? So we haven't seen we haven't heard about these things from the sales team so much because these are more point solutions. So we don't hear a lot from them in our customer sort of interactions. So coming to the pricing pressure, also there's no comparable, right? These are sort of very point solutions, as I was saying, but there are a lot of other workflows that people that the platform addresses that people sort of spend time on, which we sort of holistically do. So in terms of competition intensity, it's probably remained the same. I would say in the last 1 to 2 years, we have not seen any change in that.
Fair enough. Thank you so much.
Thanks.
Thank you, Ayush. We had 3 questions on the chat window. One of them is from Aditya Iyer. Any changes to the 30% revenue growth guidance? How is the visibility to achieve the same basis the sales funnel? And then we have 2 questions from Ajit Kumar on the chat window. Actually, one last question. Yeah.
So yeah, probably I'll just take the one from Aditya.
Chat window.
Yeah. So I think we continue to sort of maintain that like if you look at the revenue historically, the last 3 years, we have grown at about 30% CAGR. And we have been investing a lot in the GTM initiatives. Obviously, the markets have been the worst that that they were in the last quite a few years. So coupled with that, we still the revenue has not degrown. The revenue continues to sort of grow, and we have now also seen the momentum sort of pick up. So we hope to sort of achieve back to the sort of historic level within a couple of quarters is right is the sense. So that's on the first question. And
Yeah. And now, so Ajit Kumar's question is, in line with my previous query on non-core source of revenue, if I understand your view correctly, you are trying to focus on 1, consulting / advisory service, 2, customized data solution. Is it right?
So just to answer the question, of Ajit, so there is no custom or consulting services that we offer. It's like most of the financial data platform, it's a platform subscription. So 100% of our revenue from operations is actually platform subscription, and it's fairly standardized. So we obviously keep adding a lot of data modules, personalization features, support which is there through the platform. But there is no sort of services component or consulting component which is there that we have to do for customers. The customization also that happens with the platform is very productized. So if someone is tracking like a healthcare sector, they can set up a different feed or different set of alerts or different set of companies views that they want to look at versus someone who's tracking financial services, or someone who's looking at Europe versus someone who's looking at, Southeast Asia. Right? So they can actually set up a lot of those things on the platform, and our team, our support team also works with the customers, when they are getting onboarded. But there's no custom sort of data solution that we offer. It's all part of the platform subscription, like most of the financial data that you may have seen. So hopefully that answers the question completely. I think Rahul has a question.
Yeah, so I think in the interest of time, I think we will have to close this now. In case if you have any further questions, you can reach out to management at investor.relations@tracxn.com. I will not pass it out to Neha and Abhishek to give the closing remarks.
Thanks a lot, Samir. Thanks a lot, Siddharth. And thanks everyone for joining us today. I hope you got a good understanding of a recent business update and we've been able to address most of your queries. In case, as Samir mentioned, if you have any follow-up queries, please feel free to reach out to any of us. I'm Neha at Tracxn.com, or you can reach out to Abhishek and Prashant, or you can write to our team at investor.relations@Tracxn.com. Thanks again and have a good rest of the day.
Yeah, thank you. You can now disconnect the call. Thank you.